Dear participants, I'm very pleased to welcome you during today's Tax Club on financial transactions. This presentation will be led by Daniela Hockelmann, who is a partner in our international tax practice focusing on treasury matters, Fernando Longares, who is a partner heading the technology and life science sector, and I'm Christian Schlesser, a partner heading the commercial, industrial and public sector. In this webcast, we are going to first focus on the technical content of the OECD paper on financial transactions. We are then going to explain to be done more compared to the past, and then we will have three use cases from a tax and TP perspective. Let me first set the scene here. Transfer pricing experts have been waiting for this paper for quite some time, as we knew that it was in the make. Not all countries were of the same opinion, and therefore it took more than 1 year longer than initially expected until the paper was made public. Even though the paper was written from a TP perspective, it can generate quite extensive tax consequences, specifically concerning income tax, net wealth tax, withholding tax. In particular, when the question is raised if a debt to equity ratio can be supported or if a debt instrument shall be requalified into informal capital. What matters most for the Luxembourg taxpayers is if the OECD paper is of immediate application, like in Belgium or the UK, who apply a dynamic transposition of the OECD transfer pricing guidelines, or if the income tax law needs to be changed to apply the new OECD paper in Luxembourg. Of course, at EY, we have an opinion on this, which we will share with you, even though there was no written statement from the tax authorities or from the legislator. We believe that the response will depend on the two following reflections. First, the taxpayers shall be prepared that the tax authorities have now an additional weapon that they did not have before when they wanted to challenge a structure or a transaction. So taxpayers, tax authorities and advisors can therefore not ignore the content of this OECD paper. Second point, Luxembourg does typically not apply a dynamic approach for the application of the OECD commentaries to tax treaties. We believe that the same should be the case here, and therefore it is important to understand if these commentaries can supplement existing guidance provided in Chapter 1 to 3 of the OECD TP guidelines, or if it is to be seen as a new Chapter 10 of the OECD TP guidelines, if it is a new chapter. We believe that the Luxembourg legislator would have to clarify that this Chapter 10 is also applicable in Luxembourg, because currently Luxembourg income tax law has only embraced Chapters 1 to 3 of the OECD TP guidelines. In the example section, we will highlight the risk and recommendation to the questions at stake. I'm going to change over to the next slide, which is then the practical approach that we are applying here. So, based on the comments that I made previously, we believe that the OECD paper is very relevant for companies for the technology, life science and commercial sector. Because indeed, the positions of the OECD paper may affect structures that have been implemented before COVID, which were focusing on group simplifications and leading to the reduction of intra-group transactions, or to the centralization of manufacturing in low-cost jurisdictions, or close to key suppliers and customers. In an after-COVID world, we will see even more financial transactions which will be implemented in order to finance the change of the business models to accommodate the new normal habits in terms of procurement, manufacturing and customer service. So now Fernando will explain which are the obvious takeaways of the OECD paper that will matter for companies operating in the commercial, technology and life science sector.
Good afternoon, everyone. As Christian said, this new paper from the OECD has long been awaited and sets the rules for intergroup financing activities. This paper deals in particular with the determination of whether a purported loan should be regarded as a loan or not. This paper is mentioning the balance of debt and equity funding that a company might afford and the fact that certain loans should be considered as equity rather than debt. This paper is also addressing specific issues related to the pricing of financial transactions such as treasury functions, intragroup loans, cash pooling, hedging guarantees, and captive insurance. The OECD representatives have informally confirmed that they consider this guidance as a clarification of principles. So this means that it's fully applicable as of the date of publication. So as from February 2020. We at EY were of the view that this guidance applies prospectively, so as from February 2020 when it was released. However, it is true that we have the need for the business rationale that is covered in Article 56 bis paragraph 7, which is an anti-abuse rule that the legislator introduced when the new TP rules were enacted. As you know, this was applicable as from 1st January 2017, and therefore we believe that the tax authorities may use this new guidance as inspiration when interpreting the application of such anti-abuse provision. As you will see, this guidance is groundbreaking for some, but also is a business as usual for other multinationals. The main change we have is that when we have an intra-group financing transaction, we need to follow a two-step approach, two-step test, if you want. This means that we need first to accurately delineate the transaction, so we need to assess first the commercial rationality and terms and conditions of the respective transactions. And this is the new step that we need to carry out. And once this is done, then we will continue with the second step, which is to determine an arm's length price. So you can see first, we determine commercial rationale, why the company is getting the loan, what is the business purpose for it, debt capacity, loan or equity, can the company service the debt, can we pay it back with the terms it has, options realistically available to the parties, what are the options that the company has to obtain the funds, is a plain vanilla loan the best option, or is a convertible loan something better considering the environment and performance? These are the questions that we need to document here. Terms and conditions, are they at arm's length? Maturity, repayment option, interest payment, conversion options, etc. So these are the features that we need to analyze and justify that a third party would be willing to grant a similar loan under same or similar conditions. And finally, group policy alignment. We need to check that this loan is aligned with what the group is doing for similar transactions. If there is a disalignment, we'll need to support why and the reasons behind. Once we have accurately delineated the transaction, then we need to do the usual work that we did so far. So we need to assess the arm's length price. These are the typical items that we need to look at. So for instance, in FinCo treasury companies, cost plus or zero profits, how do we remunerate the cash pool leader? What do we do with the netting benefit? In the credit ratings, do we use parent implied or a standalone rating? Loan pricing, comparables versus cost plus. Cash pooling, how to reward the parties to the cash pool. Guarantees and financial capacity. And now we want to show you how to navigate the transfer pricing challenges of financing transactions. We need to substantiate the business rationale of applied terms and conditions, balance the legislative restrictions, so business needs and TP requirements. This is very relevant because we have the new interest limitation rules that also apply, and demonstrate the arm's length nature of the terms and conditions, and appropriately functionally the functions that we have at the Luxembourg company to tackle the beneficial ownership and principal purpose discussions. As you can see, this is not only transfer pricing, but also tax. What are the functions that we have at the Luxembourg entity? As a summary of these two slides, the first thing is delineation is key. This is a game changer for most of multinationals. The business rationale and options realistically available have to be thoroughly explained. Financial transactions must be covered in master files and local files, so the documentation is key. And finally, there should be cooperation between tax and treasury, critical for managing the TP flows. As you can see, there is no longer only treasury item, but also tax team has to closely be involved on that. And now I want to give the word to Daniela, who will cover the tax impact of this guidance from the OECD.
Thank you, Fernando, and good afternoon, everyone. In the next 15 minutes, we will give you some insights on where we see the main pressure points for typical structures of multinationals, and we will share our views with you. The first topic we want to talk about in that context is, as you can see, the classification of an instrument. We know that there has been some controversial discussion on the impact of the OECD report on the current classification practice in Luxembourg. Our position is that the guidance given in the report on this question should not apply unless there's a change to the current law. In the following, we would like to explain you why we think that there's no direct impact. So imagine a Luxembourg group company that has taken up intercompany debt or holds loan receivables towards group companies in whatever form. We have heard that the OECD report covers the accurate delineation of financial transactions and that it provides guidelines to determine whether a prima facie loan can actually be regarded as a loan or whether it should rather be considered as some other kind of payment, in particular a contribution to capital. While the determination of the amount of the debt to be priced as a pre-step may be a rather new exercise from a transfer pricing perspective, the question whether a specific financial instrument is debt or not is not a new topic from a Luxembourg tax perspective. The OECD report itself acknowledges that its approach of accurate delineation of the actual transaction is not the only valid approach. Other approaches may be taken under domestic legislation. So what's the approach taken under Luxembourg legislation? What we do is we look at the main economic features of a financial instrument under a substance over form approach. And when we're doing that, we classify the instrument as a whole, either as equity or as debt, based on its predominant features. Where does this approach come from? Well, our income tax law does not expressly rule in which situation an instrument is to be classified as debt or equity, but the above approach can be found in parliamentary documents to the LER and is also referred to in case law. Now, while you could say that parliamentary documents are not the law itself, but they are the main source to determine the intent of the legislator, and because of that, should be considered part of the Luxembourg legislation. So we believe it is fair to say that there is Luxembourg legislation dealing with our domestic approach for the debt versus equity classification. And this approach does not make reference to transfer pricing guidelines. This is why our position is that the delineation approach of the OECD report should not be applied for the debt versus equity classification under Luxembourg tax law, unless there is a change to the law that indicates so.
So, Daniela, does that mean Luxembourg tax will ignore the OECD report on this question?
No, that's not what it means. There can still be practical implications from the report that taxpayers should keep in mind. Even when a specific instrument presents itself based on its features as debt instrument, the granting of the debt may be considered as an informal capital contribution by a shareholder in cases where no third party would have granted a debt in such circumstances. You may still remember the decision of the Tribunal Administratif from December 2018 on the qualification of equity-tainted loans. The tribunal stated that a loan granted by a shareholder to a company is to be qualified as a hidden capital contribution if the normal way of financing would have been a capital increase. In the specific case, the tribunal concluded that the intention of the company was to provide additional equity to the subsidiary rather than to act as a lender. There has also been a similar judgment of the Cour Administrative 1 year earlier on profit participating loans in the same direction. If you look at the criteria used by the courts to qualify the loan as informal capital contribution, there may be certain similarities to the indicators given in the OECD report on analyzing other options realistically available. Fernando, let me ask you, do you see specific action needs from a transfer pricing perspective for financial instruments, be it new or existing ones?
From a TP standpoint of view, we think that the current and new instruments, they have to be assessed on whether they comply or not with the Chapter 10. The tax authorities will use this, as said before, as an inspiration also for the interpretation of anti-abuse provision of Article 56 bis, paragraph 7, which is applicable as from 2017. We met the tax authorities and they clearly said that business rationale is there since 2017, so they think that Chapter 10 is a mere clarification that helps them to interpret how to apply this provision.
Okay, so Fernando, do you believe that this is the end of the interest-free loans?
No, I don't think so. I think that they can be viable as long as we can document that there is a business purpose for them. We are internally doing some research and we have good grounds to support it. So in a nutshell, this is a case-by-case analysis that could result in a positive outcome. We just need to do the right analysis and support it. So I have a question for Daniela. So what is the tax risk here?
Well, I mean, a different classification of an instrument could lead to, well, first of all, the denial of interest expenses. Secondly, it could have withholding tax consequences. And thirdly, it could lead to an increased net worth tax liability. Now, to summarize on this topic of classification of an instrument, in our view, the guidance in the report should not directly impact the classification as equity or debt in Luxembourg, but elements of the report may be regarded as guidelines or may be used as inspiration to assess whether an instrument constitutes informal capital or to assess the anti-abuse provision under Article 56 bis. Another topic that we wanted to discuss with you is the impact of the OECD report on typically applied debt to equity ratios. And what comes to our mind first in that context is the 85-15 debt to equity ratio that is typically being applied to holding activity. Christian, you have received direct feedback in a recent discussion that you had with the Luxembourg tax authorities on this. What did they say?
Yeah, Daniela, I've actually been discussing the debt to equity problematic with the tax authorities in early February. So this was 2 weeks before this OECD paper was published. Obviously, the tax authorities already back then that this paper was in the make and what content would be. So the tax authorities already made a very strong statement, which was there is no 85-15 reference in the law, and there has never been. They write this, but in the law or legislation, we could even not find references in the parliamentary documents. But however, there have been a lot of rulings or tax assessments that were issued where clear reference was made to the application of the 85-15 ratio. And this reference was also clearly included in the two études fiscales that were written by so at the time the tax authorities made this statement, I was not sure if this would be an opportunity for our clients. So we looked into the debt capacity of our companies that are active in different businesses, and we concluded that the current debt levels could in some instances, but not in others. Now, Fernando, luckily we did not conclude that this is the end of the 85-15 or of the 9:1 debt to equity ratio for all our clients, right?
Yes, indeed. This is not the end per se of the 85-15 ratio, but we need to prove again that this is what a third party would be willing to lend. We have done our internal benchmarks, and I can tell you that this is feasible for some cases. So the industry, the fact pattern is key to determine the validity going forward. The results may differ depending on the industry, but we have seen that in the brokerage sector, for instance, with asset management, we could justify 90-95% of that. So as you can see, this is feasible. We need to just be careful and prepare a strong defense file, because this is what the auditor and the tax authorities will request.
And Daniela?
Well, being challenged on the debt to equity ratio could lead to a denial of interest expenses. This would be mainly affecting companies with mixed activities, I would say, meaning cases where non-deductibility is not already the result of the interest limitation rule. And in addition, where the debt also serves as a repatriation valve, a challenge of the debt to equity ratio could also have withholding tax consequences. So, Christian, let's focus now on a last example that we are seeing a lot in COVID times, which is the recourse to cash pooling.
Yeah, thank you, Daniela. Indeed, I see a lot of times they're operating entities through intra-group loans or cash pools these days. It's a fast and flexible way to deploy funds in those companies that are in need of finance. So these days, the cash pool leader is sometimes a company that is bank or debt fund financed, and the leader pushes then the cash down to the pool participants. This may end up in interesting situation where the financing margin is negative in Luxembourg due to the high interest rate applicable on the external debt and the low return on the cash pool. So, Fernando, does the negative margin mean that those structures will be challenged by the tax authorities each time?
Yes, we believe that this will be the case. We have seen some multinationals with short cash available and that have requested bridge or long-term financing to third parties. These funds are on lent via the cash pool to the cash pool participants, and there is where we have an issue. How can we justify that a long-term loan is on lent on a short-term basis? How can we justify the mismatch of rates? Who will bear the cost? Do we need to change the policy for the new funding and keep the regular cash pool going in parallel? These are the questions that we need to document in the business purpose memorandum.
Fernando, is there any other change that you see which is relevant for cash pools or other treasury activities?
The main changes is the accurate delineation of the transaction. It means that we need to justify the business rationale, the options realistically available, the debt capacity. Can we repay the debt that we will obtain? Why a third party would be willing to grant such loan? These are the main changes and should be properly justified and documented. Contemporaneous documentation here is key. This is something that you cannot produce easily afterwards once the transaction is executed.
Yeah, clients did not benchmark the return accruing on the cash pool. Instead, they have been utilizing interest rate offers from the banks, and I do know that the tax authorities have not challenged those in the past. The OECD is, however, now making clear that this is not good anymore.
That's correct. The OECD has clearly said that non-binding offers from third-party banks are not reliable, and therefore a full benchmarking analysis with third-party comparables has to be prepared.
Mm-hmm. The other setup that we have seen a lot as well is US, Hong Kong, or Swiss finance branches. These are not debt finance, but endowment capital finance. With structures that under scrutiny, I mean, in particular, in terms of capital documentation, head of cash participants need to be remunerated. Fernando, what do you think there?
Yeah, in terms of capital endowment, nothing has changed since this was already covered in the paper of the OECD, which is titled Attribution of Profits to Permanent Establishments, where they deal with the head office remuneration as well. So in terms of the cash pool participants' remuneration, we have to say that the paper clearly says that the benefits should be present at the level of both cash pool leader and cash pool participant.
Okay, so our recommendation here is that groups should maintain strong documentation going forward on the branch's profit attribution. And this analysis could actually complete the defense file where the functions, risks, and assets of the foreign branches are described in order to demonstrate to the Luxembourgish tax authority that the new standards applicable since the 1st January 2019, the benefit of the permanent establishment exemptions are met. I want to emphasize here that it is recommended to have a strong branch setup because the passive holding of loans in a foreign branch will not be sufficient to meet the permanent established exemption test under the new Luxembourg law, which is applicable since last year. So if you cannot demonstrate that you are meeting the requirements of the new law, Luxembourg will tax the income of the foreign branches at 25%. If you're lucky, you will get the credit on that for foreign taxes. So, dear Daniela and Fernando, we now come to our last slide, and I hope that the participants agree with us that the OECD paper, and in particular the emphasis on the two-sided and two-step approach, is a real game changer for a certain number of structures. It is not necessarily the end of the interest-free loans or convertible preferred equity certificates, popular funding structures, but it's the beginning of a new area where documentation of the transaction will complete the documentation that most of the taxpayers have already been preparing in response to the anti-abuse rules that were strengthened in Luxembourg recently. So, Fernando, for participants, the way we typically assess the OECD paper on financial transactions compliance, or where Luxembourg companies are involved?
Yeah, so we suggest a three-step approach to summarize required actions. So first is identify and assess the existing feature structure. Second is to enhance the structures or restrict them that cannot be in compliance with the Chapter 10. And third is to adapt and to implement these changes in the structure. So now, Daniela, that we reached the end, what kind of questions did the participants to the webcast raise?
Yeah, thanks, Fernando. In terms of questions, there was one question whether, and that's maybe one for you, Fernando, whether we are expecting a specific change of the law in Luxembourg to implement this Chapter 10.
No, I don't think this is foreseen in the short term. Based on what we have discussed with the tax authorities, again, they consider that this is a mere clarification, and therefore they can still already use Article 56 as the anti-abuse provision, and therefore we don't see this change coming soon. So for now, this is not the case.
Mm-hmm. Okay. And there was another question to how we are expecting that the tax authorities in Luxembourg would act on these changes, whether they would proactively go after specific cases, or what is our expectation here. I would say that for now, we don't know whether the tax authorities would actively question, for example, the leverage of holding activities for new or maybe even for existing cases where the tax years are still open. It's also difficult, I would say, to predict to which extent they will be inspired by the report to classify debt as informal capital or to claim anti-abuse provisions. But our clear recommendation here is be prepared for challenges if they come, and make an assessment now whether an existing structure may have to be enhanced or adjusted in order to be more solid.
Yeah, maybe you could wish tax authorities to look into structures differently than in the past, no?
Yeah. There was another question whether we are already seeing clients to act on these new requirements. Fernando, what are you seeing here?
That's a fair point. Yeah, the answer is yes. We have seen clients, and we are working with clients already, helping them to assess their structures and see the gaps that they may have with regard to Chapter 10. So the answer is clearly yes.
And another question maybe for Christian. Are we expecting auditors to raise questions on the application of Chapter 10?
Yeah, I think it really depends on the cases, but it is very likely that the EY auditors will ask for documentation for tax years starting 2020, because as Fernando said at the beginning, we believe that this is something that will be applicable prospectively. It cannot be excluded that other auditors or other advisors will already ask for it before.
There's another and maybe final question, whether CPECs, so convertible preferred equity certificates that we have been seeing a lot in the past, are now more at risk than before. Christian, what do you think about this one?
The same for all those financial instruments that we have seen a lot in the past. So interest-free loans, interest-free PACs, income participating loans, CPECs. It's all about the terms and conditions and the business case documentation. We came across interest-free PACs, for instance, in the last weeks, where we did not get comfortable, while at the same time we have seen the implementation of others where we got comfortable. So the devil is really in the detail of the terms and conditions of the instrument and on the business case for both the issuer and the holder. Unfortunately, coming to the end of this webcast, we wanted to thank you very much for your participation and questions. And so we will reach out separately to those people that had additional questions that could not be answered here. Thanks a lot, and bye-bye.